Firms often grow their businesses by acquiring other firms. To ensure a successful acquisition, the acquiring firm must not only choose a high-quality target, but also persuade their investors that the respective acquisition will benefit the acquirer firm. This raises the question, how do investors assess whether an announced acquisition is beneficial for the acquirer firm? To examine this question, researchers employed fuzzy-set qualitative comparative analysis on a sample of 1,867 acquisitions performed before, during, and after the Great Financial Crisis of 2008-2009. They found that investors assess acquisition deals holistically based on acquisition recipes, meaning a large set of signals that convey the attractiveness of the deal and the competence and governance effectiveness of the acquiring firm. In other words, investors seek to understand 1. How much value can this deal create for the acquirer? Deal attractiveness. 2. How much value can the acquirer capture from this deal? Acquirer competence. And 3. How well are investors' interests protected by corporate governance safeguards? Acquire corporate governance. When financial crises disrupted traditional proven recipes, the investors' preferences changed as well. In particular, investors became more explorative in search of crisis-proof recipes and reacted favorably to a wider range of deals. However, investors became more risk-averse, with a marked shift in preference towards domestic deals, probably because international deals are perceived as too risky. After the crisis, the recipes used by investors did not revert to pre-crisis times, suggesting that crises have long-term effects on the preferences of investors. Instead, the investors became less explorative than during the crisis, while they remained more explorative than before the crisis. The study also highlights that during post-crisis, investors exhibited greater risk tolerance than during the crisis and reacted favorably to riskier deals, such as large or international deals. Importantly, investors started to place a higher emphasis on good corporate governance practices, such as board independence. This may reflect a control rather than prevent strategy. For acquirers, risky deals may sometimes be attractive because they provide new opportunities for growth and organizational learning. Instead of dissuading companies from pursuing potentially beneficial yet risky strategies, investors now prioritize governance mechanisms and financial stability. This shift aims to safeguard their interests and enable acquiring firms to mitigate potential setbacks.